Good afternoon, everyone. This is Rob McDougall from Zhang Financial, here with your weekly economic update. Today is Monday, April 20th, 2026. So last week, economic data, pretty sparse in total in terms of how it turned out, pretty good. So we'll just hit the highlights or the most important points, show you what happened with the markets, show you the economic data to be released this week. So last week, we'll just start off with the PPI numbers. Now, investors super focused on inflation, everything to do with the Iran war, gas prices up, and the expectation is we're going to have a quick run up, and usually it starts in PPI, the producer price index. However, expectations were well ahead of reality, worse than reality, as it turns out. So for March, the core PPI was released, and the month over month was expected to come in at a 0.5% increase month over month. It came in at only 0.1. That's for the core. For the headline number, the month over month was expected to be really bad, 1.1%. It came in bad, but not nearly as bad, at a 0.5% up month over month. So that was good news. Initial jobless claims, which has again been a highlight, we think, over the last 3 months. And very seldom has a consensus actually been lower than the actual. And again, this week, or I should say last week, same thing happened. The consensus estimate was for 215,000 new claims, came in at only 207. So economic news last week, favorable. Inflation expectations, no change from the week before. So the expectation for the 10-year break even is 2.36% average inflation over the next 10 years. Again, didn't change week over week. Pretty solid number. In terms of expectation for GDP growth in the first quarter, which ended March 31st, the Atlanta Federal Reserve Bank, we always quote, always cite, expects that first quarter GDP to come in at 1.3% growth. That's consistently been down. Their estimate has been. Peaked at 3.4% about 2 months ago. And virtually every week, they bring that down incrementally. So we'll see this week. There's a new reading on it tomorrow, which is Tuesday. The Fed funds situation and the expectation for cuts or hikes. We do have a Fed meeting at the end of this month. Virtually no chance of anything happening either way, a raise or a cut. However, when we look at the end of the year, and this has been very fluid and very interesting, it's changed so much week from week. So this week, the expectation by the end of the year, December, in terms of rate cuts, there's now a majority, or 51% probability built in that there will be no change at all, but maybe more importantly is the fact that now there's no expectation at all of any rate increase. Just a couple of weeks ago, we had a fair expectation of one rate hike and a possibility, but slim, but a possibility of 2 rate hikes. Now the market's pricing in virtually no chance of any rate hike and 51% odds of no change at all. And 38% then of 1 cut and 11% of 2 cuts. So that's much healthier than the probabilities for Fed funds futures that we talked about last week. Last thing from this week, corporate earnings. We started corporate earnings. Corporate earnings are the review of the first quarter 2026 earnings, and most of the companies that are reported so far have been financial, some tech companies. But as of the end of the day Friday, this is just a fantastic start. There's just no way around it. 10% of the companies have reported as of the end of the day Friday. 88% beat. That's way above the 5-year average at 76%, 78%, and better than the 10-year average of 76%. And even more impressive is the magnitude of the beats, 10.8% above expectations. So the 5-year beat average is 7.2%, so 7.3%. So this is a fantastic start for corporate earnings, and now the expectation for this quarter, with the 10% that have announced earnings, 90% haven't. The expectation now has been raised that the earnings growth year over year, first quarter, S&P 500 will be 13.2%. Just a week ago, expectation was only 12.2%. So with that relatively good news in terms of the economics last week, how did the markets respond? Well, again, this is now the fourth week in a row. Fantastic returns in the equity markets. Just 4 weeks ago with the Iran war, investor concern, inflation, everything, stocks were tanking, but they have come back very, very strongly. So last week, S&P 500 up 4.55%, really driven by the Mag 7, which was up 8.4%. So during the week, the growth way outperformed value. Growth up over 7%, value up only 1%. Large cap slightly beat small, large cap up 5%, small cap 4%. So when we talk about growth value, growth was way behind just 3 weeks ago. Now is pulled almost even, or better than even, with value. Growth in the U.S. equities up 5.7% year to date, value up 5.5%. In terms of international markets, they continue to outperform the U.S. So S&P 500 year to date after last week back in the black, up 4.47%. But developed markets ex-U.S. even better, up 8.5%. And last week, emerging markets with another good week, up 14.2%, well in excess of the S&P 500 year to date. Last week, another good week in the fixed income, the bond market, 2-year yield down 10 basis points, the 10-year down 9 basis points. So bonds rallied, and the U.S. aggregate bond index, the Bloomberg U.S. aggregate bond index, up 55 basis points last week. So this week, kind of another light week in terms of economic data that will be released. We'll just hit the ones that we think really matter. Tomorrow, we'll have retail sales coming out, retail sales month over month, retail sales ex-auto. So the headline number month over month is expected to be up 1.3%. That's for March. The February release was only a positive 0.6%. And then if we strip out the more volatile auto, the expectation is month of March, auto retail sales ex-auto up 1% month over month. Month of February, that was up only 0.5%. As always, initial jobless claims on Thursday, and the consensus came down a little bit further to 212,000. Remember, I mentioned moments ago, last week the report was only 207,000. And I know last week or the week before I vowed not to use the Michigan Consumer Sentiment Index, but unfortunately we slipped it in. And the expectation is horrible. Expectation for April is 47.6. Month before, month of March, it was 53.3. But I'll continue to discredit this survey in terms of any predictive value because it seems to be much more of a contrarian indicator in terms of consumer spending than it is a current indicator. So that's it for this week's wrap-up. We thank you very much for your attendance. We'll look forward to seeing you next week. Thank you.